Good afternoon and good morning to everyone, depending on your time zone. This is Muhammad Abu Akla. I am a contributing member of Shumul, and this is our last episode, or the last of the series with the IFC. We've discussed a few of them before, and this topic today is going to be about agent networks. I'm happy to welcome everyone who's joined us and glad to have you here on this busy afternoon or morning again. And special welcome to Margaret and Jerry from the IFC. And I am not going to introduce them. Hopefully you know about them, but they will introduce themselves as well. So we're going to start with Margaret, and then Jerry will introduce himself. And then we'll take a few minutes for Margaret to basically present the details about the IFC, as well as a summary of the sessions that we've covered so far. And then we'll pass on the mic on to Jerry to discuss in details the concepts of agent networks and some of the challenges and the opportunities there in the context of the IFC work that he's been doing. Then we'll summarize at the end, and we'll take questions and answers. And meanwhile, if you have any questions, you can definitely shoot them through the chat, and we'll look forward to everyone's participation and engagement. So without further ado, Margaret.
Thank you very much, Mohammed. Yes, my name is Margarita Viales. I build IFC's digital financial services practice, and I'm working with the team on Africa specifically to help expand mobile money and other digital financial services across the Horn of Africa. I hope my audio is good. If not, I may need to do something. We have hosted jointly with Shumul a series of webinars. Starting off, I think, with one webinar around, oh, hang on, sorry, I'm trying to share my screen at the same time. So we kicked off our webinar series talking about policies and what is an enabling environment for mobile money, specifically in Sudan. The second series in the webinar was focused very much around partnerships. How do you build partnerships between different market players, and how can this help expand access to financial services? And then 2 weeks ago, we spoke about payments, specifically bulk payments, and how different forms of bulk payments can help drive use cases and uptake.
Sorry, Margaret, could you please stay close to your mic? People are having trouble hearing you.
Thank you. I think I will need to get a... Sorry for running away. Is this better?
If you make the volume louder, we can hear you better, Margaret.
Oh, I don't know. Okay, is this working?
Sounds good to me, but I have to check with the rest. Does everybody can hear Margaret okay?
Okay.
Yep.
I can hear.
Okay. Apologies for these technical glitches. After 180 days on Zoom, or no, 440 days on Zoom, this shouldn't be happening. But anyway, so this is the final part of a series of so far 4 webinars we've hosted jointly with Shumul, looking at different aspects of how you can drive financial inclusion leveraging technology. It is part a little bit of also IFC's COVID response, where we're looking to help move away from cash to limit personal transactions, etc. So today's webinar will focus very much on agents. How do you build out viable agent and merchant networks to increase footprint beyond what you normally would have with the banking infrastructure? And Jerry will speak about that in a little while. I wanted to take this opportunity, as I know we've had a various participants in different workshops to just very briefly talk a little bit about who IFC is, and what we what we do. So IFC is a private sector arm of the World Bank, right? We're part of the World Bank Group, but we work with private sector solutions or private sector players to develop solutions in developing countries. Within the IFC, there are 4 focus industry groups. The one that Jerry and I and my colleagues on this call are with is the Financial Institutions Group. And IFC provides investment and advisory services with the objective to create impact by digital financial services to expand financial inclusion, with our SME banking solutions to help SMEs better access financial services, etc. So we have a number of areas we cover, but digital for us is cross-cutting to try and it's a way of how to do things and how to get more SMEs banked, bring in more individuals. We work with some 2,000 clients worldwide. About 1,000 of those are financial institutions. Africa is increasingly a focus where we're really trying to move the needle. What IFC's mission is, of course, to generate development impact, and we measure our impact in how we can help mitigate climate change, how we can increase access to finance, to help people and businesses do more, create jobs, and support economic development. In digital financial services particularly, we've worked with some 40 entities across the African continent. And as you can see from our case studies, it's reasonably broad. So it ranges from banks through mobile network operators to also fintechs, where we provide advice on how to build agent networks, how to increase uptake, strengthen the value proposition for consumers, but also support banks in their digital transformation journeys. So when we work with clients in the digital financial services space, we have a value proposition or an approach that varies from sort of looking at the strategy through what are the different products that are offered and that may be appropriate, also including human-centric design, what are the best channels to reach the target audiences that we want to reach, how do we help customer acquisition. All of this is typically grounded in very deep market research and a deep understanding of consumer needs. We do help with the technology piece and data analytics as well, specifically for driving uptake in lending products. Increasingly, risk management is becoming important, also looking at cyber risks. And when we talk about digital transformation of financial institutions, we are finding that one of the biggest challenges is really managing institutional change. Okay. A lot of what we do, we learn how things might work, what may be best practices. And our learning we publish, so it's available for everyone in the market, no matter whether we've worked with them or not. We host partnerships events to share knowledge across different countries and different continents. And we've published a series of handbooks that, again, are downloadable from IFC's website that can summarize our learnings from our work with clients on how to best do data analytics. How can you use digital financial services to promote agri-finance, supply chain finance, merchant payments? How do you manage risks in digital financial services and how do you select alternative channels and technology? Right? That's a handbook series, and we have a specific piece of work also that looks at how do you specifically target women? So gender and digital financial services. I think I will leave it at that. If you have any questions as to what IFC does, how we can engage and support, feel free to reach out through the chat. I don't know if anybody does have a question. We can maybe take 2 or 3 minutes, Manal, for them now. Otherwise, I would pass it over to my colleague Jerry,
Margaret,
who will do the content discussion on agents. Yes.
this is Mohammed. So can you just quickly, maybe in 30 seconds each, just summarize each one of the series that people have missed, that IFC had hosted with us, just so everyone gets a context of how you're building this ecosystem for digital financial services?
Yes, absolutely. Sorry, I think I kind of talked to that a little bit when I had mic issues. So we started the series off jointly with Shmuel and Sibos in late March, early April, and the very first webinar we discussed policies. So what is a good policy enabling environment that can support the rollout of mobile money specifically and digital financial services more generally, using some case studies from other countries, etc. The second webinar, which was in late April, we discussed, or mid-April, just before Ramadan, we discussed partnerships. So how do you build viable partnerships between different market participants to enable each of the businesses to do more and to have a business case for every participant in a potential partnership. So if you think of partnerships between mobile network operators and banks, who can bring what to the table, or banks and fintechs, or fintechs and mobile network operators. A large part is really thinking, what does everyone do really well, and how can you leverage your organization's respective assets to have one and one be three, right? So to be doing more. And then in the third series, we spoke about payments, specifically bulk payments. So what are bulk payments? Salary payments, government to person payments, bulk payments in, for instance, agricultural value chain to smallholder farmers by an off-taker. And how can these bulk payments help really drive uptake of mobile money and other digital financial services? What do you need to put in place to be able to leverage them and digitize bulk payments? And today, the last of the series of 4 webinars is really going to look at agents. So how do you get, so it's driving away from supply to the market, more to the demand side, right? So if you go digital and if you really expand mobile money, how do you get into and out of the system from the consumer perspective or the user perspective of mobile money? So Jerry is going to talk about building out agent networks and what make good agent networks. What do you need to think about if you want to move people into mobile money and into agents? And I mean, Sudan has a very specific environment because you have a parallel system through the airtime transfers. Yeah, so that's going to be the focus of today's and last webinar. And then we'll see how we will take it forward with our partnership with Shmuel and hosting other events. Great.
Thank you so much, Margaret. Really appreciate it. We'll now hand the mic.
Sorry, Mohammed.
Go ahead,
also, just to indicate as well on what on the past webinars, as Marguerite was telling us, you can also find them on the Shmuel YouTube channel, as well as on Facebook, if you had missed any of the past 3 webinars. And you'll also find this one uploaded on the YouTube channel as well.
Brilliant. Thank you so much, Tony.
That's all.
Great. Does anyone have any question or care to comment on the information that was shared by Marguerite? Okay, if not, we can always take questions at the end, or you can just, if something comes up, you can post it in the chat. We'll go ahead and move the mic over to Jerry, so he can start indulging us in the last piece of the puzzle here about agent networks. So go ahead, Jerry, take it away.
Thank you, Mohammed. Thanks, Marguerite. Thanks, Tumi. Good afternoon, everyone, and good morning, wherever that's applicable. Good evening as well, if you way ahead of us. My name is Jeremiah Siagi. I'm a digital financial services specialist with IFC, part of the Financial Institutions Group. I specialize in the area of distribution, that is the management of agent networks and merchant networks. We've been doing this across sub-Saharan Africa for some time now. I've worked in close to 15 different markets in depth in Africa, and more recently, we've started doing some work in the Middle East. So whatever I'm going to share with you is partly based on my own personal experience working in the telco sector, rolling out a mobile money platform in Kenya, and also partly from working with various clients, banks, telcos, and MFIs across the continent. So it is going to be a lot of sharing, I would say. No one has the monopoly of knowledge, but we'll share with you what we believe are best practices and what we've seen. And this particular part of the series is interesting because we are talking about the agent networks. These are really, it's really the rails upon which mobile money tends to run. And we are also observing that in this particular case, we have a very interesting environment where, we have sort of agents who are not really agents the way we know them, but of course we are aiming at rolling out a system that actually would work for mobile money. So there is a lot to be, I would say, to be refined, a lot to be discussed, because the strategy has to take that environment into account. Okay, so if you allow me, I don't know whether you can see my screen.
Yes, we can.
All right, great. Okay, so
if you can just turn it into presentation mode, it'll be easier to view the text on that room. Yep, now we're good.
Exactly. Yeah. So I just want to start with an introductory comment about agent networks before we go into, how we actually build resilience through these agent networks or build resilience within the agent network. Agents, as you may know, are people who tend to run their own other businesses. And when you get them into mobile money, there are things that have to be done right. Number one, your selection has to be done right. If you don't select the right agents, you will struggle. Number two, you have to train them right. If they don't understand what it is they're supposed to be doing, then they probably will not give you the value that you're trying to get out of them. Number three, you have to support them. If agents are not supported, they easily turn their attention either back to the business they were doing before, or they find something more interesting to do, and they leave you struggling. So apart from supporting them, and again, supporting them here means a lot of things. You have to visit, you have to know what their needs are. If they have issues, they have to be resolved in time. They have to also see that they're actually making money. Essentially, they want to make some money out of this platform or out of this service, and therefore we have to make sure that they are well supported and they're also communicated to. Yeah. And lastly, they also have to be shown very clearly, very, very clearly, and this has to be demonstrated, that whatever they're doing is paying them. And now this is what gives us the background upon which we are going to discuss certain aspects of agent network build out and roll out, and actually making sure that the network is sustainable and is delivering continuously. Now, we will talk about two aspects. There are many aspects we could talk about, but today we will talk about two aspects. There's one, which is facilitating the lending. Now, agents, one of the problems that they have is from time to time, they will run out of money, they run out of working capital, and that becomes a problem. But the other one is how then does the ecosystem evolve and become interoperable, because this has also been asked from the previous session. So we'll try to just address the two, but it is mainly about making the agent network more resilient by facilitating the lending. Again, lending here addresses the core of what an agent does. It addresses the core of the agent banking business, that is liquidity. If the agents are not liquid.
I'm sorry to interrupt you, but are you moving over the slides? They are not moving in the screen.
I will move the slides.
Oh, sorry.
I will move the slides. Those are just introductory remarks.
Okay.
Thank you. Right. So the reason lending is critical to the agent network is because without sufficient liquidity, the agent network will not deliver. The agent network will struggle. And many times these are small business people, small businessmen and women who are trying to offer a service, but as the market grows, the demand outstrips the availability that they have for capital, and therefore they will need some additional working capital from time to time. And this is really the background upon which we're going to discuss this lending to agents, as a way to make them more sustainable and more profitable. Okay, right. So let's start from how the funds flow. I believe we all know this to some extent. Basically, you have agents and merchants. Again, in many markets, agents and merchants tend to be the same people, or part of them playing both, but they're two different roles that they're actually playing. For agents, basically, you're talking about cash in and cash out. In most places, they just convert the cash into the e-value or e-value into cash. And this is really the business that they are in. The stock that they're trading here is the liquidity, really. That's really the money that they need to be looking at. That is the commodity that must not run out if they're going to be successful. So if you look on the left-hand side, the first one is, if you flow to the right on the left-hand side, that is the customer withdraws cash. So basically, money moves from the agent to the customer, or the money moves from the customer to the agent. Either way, there's a conversion of an equivalent of e-value with cash. Now, when they do this business, what then does the benefit gain? They earn a commission per transaction, and they also get more people to get into their business. So it pulls crowds into their business. We call it footfall. So when, say, a pharmacy somewhere starts offering agent banking or mobile money services, they then attract more people who will do more than the customers they had before. The key challenges that they have is they tend not to have enough money. So they don't have enough money to handle the transactions that would come with the growth. And again, we're assuming that the platform is growing, the market is growing, and the customers are increasing. And therefore, if they started with, say, $1,000 equivalent, at some point, $1,000 will not be enough. They want to increase it to 2,000 or maybe 3,000. And usually they are not able to do that. Now, on the right-hand side, you have the merchants who basically are receiving money, supplying goods or services, but receiving money. And usually the merchant will not be earning a commission. Unlike the agents, the merchants don't earn a commission, but they still have other benefits. So they have access to their money, compared, for example, to accessing their money, receiving their money through credit card payments. When they do mobile payments, they tend to access their money easier and quicker. They can actually access it immediately. They gain access to statements because now they have some financial records, they have some financial history, and they also are able to move the same money to make certain purchases. So it makes their operations a lot more efficient than it would be if they were just handling cash. So they can avoid handling cash. Again, handling cash comes with its own challenges. Many times they fear that it can get stolen from them, even by their own employees, or sometimes they fear being robbed. And again, there's the inconvenience of sometimes you don't have the exact change. So if you can avoid all that, the merchant is happier. So depending on the regulations on each country, you could have the operators here being a mobile network service provider, or a fintech, or a financial institution like an MFI, and all these. When it comes to the agent, they operate pretty much the same way. The details may vary, but they operate pretty much the same way. So there is a problem, though, that despite the potential of mobile money services, limited availability of funds for agents and merchant networks has hampered the scalability of these services. So even when we get it right, as it grows, it becomes a problem with growth. The funds become insufficient, and this negatively impacts the customer satisfaction. Customers will get used to a service, but if they get to a point where every time they look for the service, they can't get it, then that becomes a drawback, and the whole ecosystem suffers, right? So there is need for financing. There is need to avail this extra cash, these extra funds that the agents or the whole ecosystem would need. Yeah, it is a challenge for mobile money providers to build economic viability, and they need to actually build this trust, because customers only trust when they consistently get the service that they expect. Poor float and cash management inconveniences the customers. It lowers the transaction volumes. It lowers the agent's own earning, and mobile money providers also run out of revenue, or they stop getting the kind of revenue that they expect because they're losing transactions. In some surveys that were conducted in 2016 in Tanzania, Uganda, and Kenya, agents estimated that they fail to complete 21% transactions in Tanzania, 14% of the transactions in Uganda, and 6% of the transactions in Kenya. Now, that is huge. If you're doing big business and 21% of transactions, like in the case of Tanzania, can be denied because there wasn't enough liquidity, it then is a problem. Yeah. Some recent studies, a recent IFC research shows that in the long run, poor agent liquidity management undermines the provider's reputation and becomes a real barrier to digital financial services. You don't want to create a service and then fail to provide the same service that you have got people into. So agents also face they face challenges in getting this financial support that they need because of the kind of businesses that they traditionally run. They are too small, they don't have records, and most of them remain quite informal, and therefore their loan applications tend not to go through. Okay. Now, what are the needs? What do they need? They need working capital for ongoing support, that is the cash flow management. They will need money to finance their businesses. They have bigger financing gaps over the weekends because many times they will go back and forth. They will do some transactions and find a super agent or find the bank or find the operator, get some more liquidity and come back. Over the weekend, some places tend to get closed, so the gap is worse over the weekend. We've observed in some areas that, where they're so busy, then the gap can also be wider in the evening because they can't go back and forth. They can't go converting the liquidity in the evenings because some places of business get closed, that is the banks and other places. So the investment in float is another, the very investment in float is another need for cash that they have. They need to invest to be able to transact. If they don't invest in the first place, then they can't transact. One thing that agents must also realize that they do, and that all providers also realize that the agents do, is to actually fund this ecosystem. So agents bring in the funds. If they don't have the funds to bring in, that's a problem. That's why we are discussing this as a way to make sure that we have a sustainable ecosystem. Again, there is a possibility that the operator can actually enable the agents to get unsecure financing. Now, if that happens, it's a beautiful thing. So if the operator commits to be able to push the same agents, much as it is not secured, but they have the tools, they have the contacts, they have the details to push them, they are able then to push the agents to pay back, right? So it then becomes a possibility that you will get the operators who are interested in the agent's own welfare, so they facilitate them to get financing, but in the process of getting that, they also facilitate the collection of or the repayment of this financing that happens, okay? Now, the current financing situation is an estimate of $2 billion US. So $2 billion US is what is estimated to be lacking in this ecosystem around Africa. And this then becomes a huge problem because that is an opportunity that is being forgone. It basically means the agents and the operators are missing that much in terms of the transactions or the business that they should be able to do. So how do agents currently get financing? They basically go to family sources. We've had many cases where people tell you they went and sold their animals, or they went and sold some parcels of land, or they went and borrowed from relatives. So family sources will give them some money. Sometimes they get collateralized lending from financial institutions. Again, that has its positive side. It also has its negative side. Sometimes they overcommit, and if it is the only asset they have as a family and anything goes wrong with the business, then the family gets poorer instead of getting more wealthy. There are a limited number of fintechs that are able to lend to agents, and the lenders are leveraging data analytics for consumer lending. So sometimes they are able to build their own history, and that history or those records can be used where collateral would be used, and they'd be able to get the funding. The impact of this is there's a high cost of finance relative to the market. And of course, there's low access. Not all of them can access these funds. So many of them will tend to remain small just because they cannot access the funds. So why do we have then these gaps? Number one, the traditional banking approach, there's over-reliance on collateral and direct relationship. Usually there would also be weak partnership structures between the operators and the banks, low appetite for unsecured and data-driven lending. And of course, sometimes the operators are unable to support the risk. Now, these then become an issue that will put together, prevent mobile money operations from scaling up or from remaining as sustainable as they should be. So the kind of interventions that would be required would involve deliberate partnership designs to address these specific gaps that are there. There should be some risk mitigation and or risk mitigation products, so that we take care of these risks that come with the kind of small business people that we are dealing with. There is the sheer need for funding, and that is something that IFC is able to do. And of course, working with all types of lenders. As you can see, there would be different types of lenders involved in this. Some could be fintechs, some could be banks and other financial institutions. Okay, so examples of these lenders, and this is just a very quick cross-section. We have, for example, Asante Financial Services, which lends to agents and merchants in Tanzania. And their model is they have direct partnerships with operators. So they lend based on data from the clients, and they also manage their own platform. Then we've got Onango, which lends to agents, and that is in Ghana and Cote d'Ivoire. They have the direct relationship with the operators and they recruit the agents. So KYC and all the other details are done by them. Then we have another interesting example in Kenya called Kopo Kopo, which lends to merchants, sort of like an aggregator for merchants. And they have a direct relationship with the agents, with the merchants. So they do the KYC and they qualify them, but they also lend to these agents on the basis of their transaction data. We got Jumo, which is involved and pretty active in nano lending, very active in Zambia and Ghana. They also develop their direct relationships, and then they provide small, small ticket kind of loans to the market, and this would include agents. We've got a bank in Kenya, Stanbic, that is able to lend to agents, and they have the relationship with the agents. They develop their relationships and look at the agent's transaction data, and based on that transaction data, they're able to lend to the agents. Okay. So there's some partnership models. Again, remember we said that there needs to be some deliberate partnerships, and we just want to highlight a few here. The three main, two broad types of partnerships. So you could have some that are telco-led, others that are tech firm-led. So if you're going to look at the kind of partnerships that are there, you then begin to see that they vary they vary based on what role each of these parties would be playing. So for example, in Kenya, you'd have some partnerships that are involving a bank and an MNO. So the balance sheet and the credit scoring is done by the bank. And then the data, the payment account, and the access point, that then becomes the responsibility of the MNO. And an example there is Mshwari by Safaricom being the telco and CBA being the bank. Then you've also got a model in DRC where there is a bank, there's an MNO, and then there's a tech firm. So the underwriting is done by the bank, and then the credit scoring is done by the tech firm, because the tech firm has the technology to do the credit scoring. But then the data, the payment account, and the access point remains with the MNO. The third one, which is available in Tanzania, is Timiza, which is a partnership between Jumo and Airtel. So the telco here does the underwriting, and lends on their own balance sheet. But then, sorry, not the telco, that is the tech firm does the underwriting, and they are able to lend, but then the telco still provides the data, the payment account, the access points. So those would give you the variation that you have within the telco-led side. And on the tech firm-led side, and I'm not very sure, this being an association of fintechs, I don't know which side you'd want to pay more attention to, but there are again two broad examples where you could have a tech firm and an MNO, And an example here is Branch in Kenya, which then does, they do the scoring, they do the underwriting, and then they land on their own balance sheet. They have the funds to do that. And then the MNO provides just the wallet. So the wallet into which this loan is paid, and also the wallet from which the repayment is done. The last one we'd like to highlight here is Cubo Financiero in Mexico, which is mainly done, it's sort of an internet marketplace where the biggest chunk of activities here is done by the tech firm. So they reach out to customers, they do this credit scoring, they land on their own balance sheet, they use their internet footprint, and the bank basically plays a much less role in that kind of partnership. So there is a whole spectrum, depending again on what kind of partners are available. You could then choose from any of these models to come up with something that is sustainable. Okay. So what are then the proposed solutions? IFC would propose that we consider some of these solutions and the roles. So IFC would facilitate the service by supporting funding to the financial institution. They would also be able to provide a risk-sharing facility to the network. That is, they would be supporting the financial institution in that lending business. And they would also be able to provide advisory services to support that, that product. For the financial institution, they would be playing two main roles. One is lending based on data. And they would then be able to, use the data to generate revenue. Yeah. And of course, the data now would replace the collateral. So they would be able to use the data to enable their agents to be lent or to borrow without requiring any additional collateral. So the data that is being generated by their transactions becomes their collateral. Now, for the mobile money operator, they would need to be able to avail the eligible. They will bring in the agent, the network, the eligible agents who can be lent, people who can qualify for the loans. They provide the required data for funding and of course, enforce the collection. They have a relationship with these agents and therefore they can go after them in case there is a default. Okay. So for the agents or the channel players here, agents or merchants would need to apply for the loans. Of course, if you apply for a loan and you're given, you need to repay. So they would need to make sure that they repay the loans. And of course, they would need to use these loans for intended purposes. We've been to places where agents have taken the loan, but they've taken it out of the business, or they've done something totally different. They could go and build a house or buy an animal somewhere. So that is also a responsibility that would come to the agents. All right, so the proposed risk sharing would involve the operator, there'd be IFC, there'd be the lender, and then of course the merchant. So IFC's offering would be the risk sharing facility for the financial institution on a portfolio of agent or merchant loans that originates from the operator. Of course, IFC would be able to partner with the operator and or the lender to provide financing to these merchants. From the operator, a requirement would be that they get pre-screened or qualified agents, and these are the ones that they would be presenting for lending because they have the best visibility of that. And of course, when an agent or merchant defaults, the operator should be able to go after them. So that the lender will basically be doing their own in-house credit analysis once the data has been availed to them so that they can avail the funds to the agents who qualify. Okay, so what's the revenue opportunity? How would anybody make money from this kind of arrangement? So the agents would be able to access credit, and that will increase their transaction performance. They would then be able to do better business and therefore earn better commissions, and they'd be able to get better revenues. So the funding is also unsecured, which means they will not be tying a lot of their other assets. They will basically be generating data, and the data will qualify them for better transactions. The merchants would be able to access credit. And of course, for them, when they get the credit, they're able to grow their business. They can increase the volume or the range of products that they have, and therefore make better money. Again, funding is secured, so it can only result in growth. The lenders would be lending more. They could have a new set of customers through this product, and they would be able to generate significant revenue from the interest income. Then, of course, for the operators, they would be able to have better business because they have agents who are able to expand and grow and provide the service to a wider section of the market more consistently. All right, so there are few options that are available for this to work, and there are many aspects that would be considered. I'll just go quickly through this in summary. So in terms of the regulatory approval, if you're going to go for an in-house option where you do it on your own, then the financial institution would then have the license. They need to get the regulatory approval. If it is outsourced, then it is not applicable, and the telco option the same. It's not applicable. The capital, that is the lending capital or the balance sheet, if you do it in-house, then as a financial institution, you have to manage the funding. That will not apply if it is outsourced or if the telco is doing it. In terms of the banking and accounting platform, you could choose to set it up on your own, or maybe outsource it, but choosing to set it up is a good option. If it is outsourced, then the financial institution may identify a third party to manage the platform. If it's a telco option, sometimes they can rely fully on their own platform, the telco platform. Credit responsibility, credit decision responsibility. If it is an in-house option, then you must own that decision. It is difficult. It cannot be outsourced. If you outsource this option, the credit decision is a responsibility that's difficult to outsource, and therefore it does not apply in the other two cases. Credit scoring, the financial institution may build the data mart, or if it's a case where they've outsourced it may use a third party to host the data. In the case of telco, then the data could come from telco, hence must support data analytics. And of course, the last one, the transacting channel or platform, if it's in-house, then the financial institution may develop its own channel. If it is outsourced, may work with a third party. And if it's a telco, then they may leverage the infrastructure, channels like the ones we are trying to discuss here. So what are the advantages and disadvantages? Again, the main advantage of an in-house option is it has the financial institution has most control. The option is more likely to be favored by the regulator because they know everything that the financial institution does because they are regulated. When it is outsourced, it can provide for a quick go-to-market where, for example, if we have a fintech or a cloud provider who already has suitable solution and that is tried and tested, you can actually get to market very quickly. If it's a telco option, sometimes it is the quickest because the telco is able to do everything and account for the credit scoring. Yeah. The disadvantages of the in-house option would be around, if they are not very strong digitally, then it could take very long to actually set up this kind of lending product. The outsourced option has the main advantage that if the fintech is interested in revenue share instead of vendor relationship, you may get a fintech that would want to get a share of the revenue, and then it becomes a very complex kind of negotiation instead of being given a price and you decide whether you can afford it or not, and you pay and you move on. And of course, the last disadvantage that we want to talk about here is for the telco, where they may have lack of control and it may weaken the financial institution's strategic position. Okay. So the financial institution's role is basically lending. They have the lending license. They would do the product design and marketing. They would actually lend, do the actual lending. They would do the risk management, and then they would need to have a digitized loan application system. Some of the benefits that would come with this would be customers. There would be new customers, not just on lending, but deposits as well. As you get the agents or the merchants to borrow, they will also start bringing in their deposits. There'll be increased revenue from the interest income. There'll be better understanding of the distribution value chain, because now you're dealing with people who are actually very deep into the market. There would be perception of an innovative organization. This is something that most organizations are looking for now. They're looking for that new thing they can do to shape the market in a way that favors them. And of course, there'll be risk mitigation. And the last one there would be a good perception by the regulator, because they would be doing something that works for the entire economy. The provider role, that is the MFS provider, they would expose eligible agents, that is, present them to the lender. They'd be able to do data analytics. They should be able to do the moral suasion agents, and then support marketing activities, do the key contact persons, and of course, the tech platform that will enable integration between the lender and the wallet provider. The benefits would be increase in business volume, increase in visibility, better relationship and loyalty with the agent, and of course, an opportunity to expand that lending to the rest of the people in the ecosystem. You know, it could continue to farmers, merchants, airtime distributors, and of course, the fees. So for IFC would basically cover some risk through that risk sharing facility. They would also be lending to financial institutions as needed. IFC would also provide advisory services to support the lender in product design and strategy. And then IFC would help with partnership design and, you know, just help make sure that the relationship between the lender and the wallet provider is positive. And there would also be credit scoring design and support. The benefits of this would be to increase financial institution, which is very important for IFC, open up more opportunities to support financial institutions that work with similar value chains. And lastly, there'll be revenue generated from supporting these financial institutions. Okay, so the benefits of this risk sharing product that we are proposing here. Number one would be risk mitigation. Number two, it would have some improved risk profile on the institution would then become cash flow efficient because of this support from IFC. And of course, there will be efficient capital allocation. So the institution would benefit from this relationship on this support from IFC in a number of ways as being highlighted here. Okay, so I would want now to just very quickly go over a different part of the agent network management, which is interoperability. This is a subject that is becoming much more interesting than it was before, and it's got a lot of things that we could consider for Sudan even as we speak. So mobile money interoperability basically allows customers of different MFS providers to transact across platforms. So the MFS platforms, as we all know, are usually designed as closed loop systems. That is, money or funds would move within the same wallet. But as markets develop and DFS services deepen, you will get that the industry players, the regulators, or even the customers start checking whether interoperability could work. They would ask whether they can actually transfer or send money across platforms. Now, despite the apparent advantages of interoperability, it has not been that successful in the past. Yeah, it has not been that successful. Yes, mobile wallets integrating with banks has been successful to a large extent, but mobile platforms with other mobile platforms have not been so successful. So why is this? This is largely because in many cases you find interoperability has been mandated by the central bank or by the regulator, which then doesn't address all the issues, or it has focused only on the technical part. Again, technical is very important for interoperability, but you realize it's not the most important part. So the focus should actually be on developing and implementing standard business rules for interoperable MFS transactions. That is where the focus should be, because without those rules, then everything, despite a good technology, despite the need, things will tend not to work. So IFC has acted as the agnostic facilitator between the industry partners in Tanzania, and this happened in 2014, to draft rules, rule sets for different transaction types, often called the operating rules, or automated clearinghouse agreements, or payment streams relating to mobile money interoperability. And in 2014, Tanzania actually became the first country globally to develop such clear rules that has actually made their interoperability quite successful. Excuse me. Okay, so some of the things that we've learned from the Tanzanian experience. So what would it take to get an ecosystem to be interoperable successfully? Number one, there should be some market demand. So the MFS users in Tanzania were already trying to find ways of sending money across platforms. So many of them had multiple MFS accounts and they were making cross-carrier payments through vouchers. For example, this happens, I can send you money to send money to your number, but because you don't have a wallet, you'll get a voucher, and using that voucher, you can go to an agent to actually do a cash out. So that was already happening in Tanzania. Market needs to be mature and must have or should have high MFS penetration. By this time in Tanzania, more than half of the adults had already used mobile money. So it was no longer a strange thing. We were just trying to help them push it to the next level. The third thing, the market ought to be balanced. Balance here means you will not have players that are overly dominant and others overly small. So it needs to have a fairly balanced relationship so that the shares of the market you're talking about would not be, for example, one player having 80% and another, and the rest of the players sharing that 20%. It needs to be well shared out. there needs to be a supportive regulatory environment. So the regulator, in many cases, the central bank, should be ready to support this as well. And then, of course, the MFS providers themselves ought to ask for it. They need to see the need in being interoperable. So the ecosystem works best when those factors are in place. The people who are involved in this ecosystem, I'm sure you know them, the MFIs, the government, NGOs, the card or terminal providers, money transfer organizations, banks, all these become part of an ecosystem, and therefore interoperability would serve all of them. So there are various models that I would just want to mention as we go along here. So there are some models you could consider. The first model I'd want to highlight is the platform level interconnection. So this is where most of the interoperability situations we talk about would fall, where customers of one provider can actually send or receive money to and from another provider's wallet. And therefore, they feel it doesn't matter who your carrier is, money will just flow like it flows in the banks. Agent level exclusivity, this is where now you are talking about interoperability, but it's at the agent level. Now, it's important to note that when you're talking about the agent level here, interoperability could still happen even when the agents are exclusive. Now, what does that mean? It means you could have a customer of one provider being able to use the agents of another provider. If you were to use the Sudan example, you could have a Zain customer going to a Sudatel agent and still being able to get service. And of course, the third model that could happen here is at the customer level, where the customer is able to, number one, access his account using another phone or another SIM card on the same network, or they are able to access multiple accounts using one SIM card. So those are the three levels. But the first one, the first model is the one that normally would be seen in many places. And then, of course, if you are to look at the models here, then you will have various other points to consider. You could have, you need to then have bilateral agreements between banks. That's one option. You could also have a neutral processor between mobile money schemes, or you have a commercial processor between the schemes, use a bank and a national automated clearing house, or you go for direct connectivity to the ACH. And you could also have a mix of commercial processor for the bank interface and bilateral arrangement between mobile money schemes. So these are options that could be considered as we structure interoperability for a market such as Sudan. So it's important to also ask the question, there are options, there are ways of doing it, but how ready is Sudan? One, let me just point out that interoperability is growing, and according to the latest report from GSMA, about 1 in 20 person-to-person transactions are now happening between different mobile money providers. And this has increased from 1 in 50 just over 5 years ago. So it has actually increased, and it is continuing to increase. So the opportunity is there. To make it work, there will need to be the technical part, the integration, the technical infrastructure needs to be in place. The business agreements have to be in place. So you need to have a balanced model. And then, of course, there would be governance. The governance structures or the decision-making structures need to be clear. Those are the three things that would make sure that you're actually setting up for a successful interoperable environment. Now, if you look at, and again, this is just an example, if you look at where Tanzania was in 2014, they had, one of the biggest players Okay, their biggest players was Vodacom with 47% share, Tigo Pesa 29, Airtel Money 21% of the share. Now the Sudan market share, it is not like for like, but it is indicative because you have three players, one player with 48%, that is Zain. You have MTN with 28%, and Sudatel Sudatel with the 24%. Now, that gives an indication that it is possible to negotiate without any one party bullying or bulldozing the other parties. So it is likely that a balanced agreement can be achieved. It is also likely that you would be able to have the operators recognizing the need for interoperability. And if that happens, it is a good thing. I'd like to end at that point and welcome any questions that may not have been put in the chat already. Thank you very much.
Thank you very much, Jerry. This was truly insightful, and I think it brings full circle the series of discussions that we've been hosting or co-hosting with the IFC. As Margaret so eloquently in the beginning had given us an overview of all the different series, starting with the regulatory aspect and the policy aspect, following with the partnership approach, and the third phase that we had discussed last time was bulk payment, and today we end with agent networks, which is basically the last mile of this ecosystem. While we're waiting for others to have, if they have any questions, I wanted to pose one. How do you address the problem of the agent themselves being part of the unbanked population? So, and if you can give examples of how do you invite those parts, the agent networks or the agents themselves to basically take part of in the financial system effectively.
Thank you. Yes, agents tend to come from the informal side of things. So many of them would be unbanked. But what we've seen, and I'll just draw from the markets that I'm familiar with, sometimes it is the business that gets them to open their first bank account. If you require them to have a bank account, then they suddenly find the need to open and operate a bank account because now they're going to provide a financial service. So it is, and to some extent, serious education, and to some extent, just for them to see the value proposition, what is it that they're going to gain that would make them do something that they have not done before.
Excellent, thank you very much. So over to the audience, if anybody has questions, please raise your hand or post it in the chat. I see Mr. Omarabi has a question, so Mike, over to you.
Thank you, Jerry, for this very useful presentation. In fact, I have a couple of questions. The first one, when we talk about agents and merchants, we always talk about cash in and cash out, which is, of course, very important functionality. But do you have an experience anywhere where they talk about the agents for the full stack of financial services, like selling utility, doing payments? I'm asking this question because in the case of Sudan, if we just use them for cash in and cash out, that's going to be a very difficult proposition. If we take, for example, Samarat, the family support program, they want to distribute $2 billion. And this is equivalent to 800 billion SDG. This is the total amount of printed cash in Sudan. So it's very difficult to work. I mean, if you give all the cash printed in Sudan since the Sudan started, is not going to be enough for the agent. So the program and other program, we have to make people use the money in their wallets for services, to buy services, grocery, and so on. And I think that the obvious solution in it, in addition to point of sale and so on, is the agents themselves to become also a way of providing those services, or at least educating. So have you seen this experience? Is this discussed? Is there anything to solve the problem of just the cash instead of the money circulating within the system? The other question is for lending. You talk about lending and you talk about lending the merchants and agents. Is the lending going to go to the agent at the bottom or to the main agents? Because the agent network is like a tree. They are probably 100 or less top agents, and then you have sub agents below them. And if you are talking about financing agents at the bottom of the tree, those are going to be tens of thousands. And managing them as a financer, managing them and taking the risk and all this is going to make the financing itself very expensive and very risky at the same time. So if you explain this, I mean, the financing itself, does it go just to the top agents, which is easy to manage and is less risk, or you go down to the bottom and you finance the agents? Also, you talked about interoperability in the agents and so on. And you talked about the telcos as the most suitable. They have the bigger agent network, and they are suitable and the fastest to the market, which I agree with you. But as a telco, I build this agent network. What the incentive we need to give to them so they can share this effort with their competitor actually, because the others are competitors in the mobile services. So instead of blocking this agent network for their use, we are talking about opening it to their competitors. And usually, I think this is Sudan. In Sudan, is very difficult to sell. My last question is about agents. If you can shed some light from other countries' experience, does the mobile service providers or the mobile money service provider build actually, I mean, what is dominant? Is this building the agent network from scratch, or use an existing agent network that does something else like distributing groceries or other things, and then you associate with that and you use them also for mobile money agent networks? Thank you.
Okay. That is quite a list of questions. I'll do my best to respond. And if I missed any details about any of them, kindly just remind me. But I'll start with the range of services that agents would offer. And I would say typically agents don't do just one line of business. They don't just do cash in, cash out. They're usually involved in other lines of business to make their business more viable. And therefore, I would be inclined to think that they should be allowed, if not encouraged, to actually run all other kinds of business. They could be agents for mobile money, and if electricity is another channel that they could use, or airtime, or whatever else would increase their ability to remain sustainable, then they become stronger. Typically, we find agents that are running all other businesses, and it keeps growing. So that would be my response. The question then would be, is the operator going to enable all these other services for the agents, or is the agent going to do them through a different platform? I would think that if the operator can enable at least some of these, then it becomes a cleaner business for the agent that would be rewarding them, and they'd be able to become more sustainable. Now, the second question was about lending. Are you going to lend to the agents or you're going to lend to the upper levels, say the super agent? I think it is possible to do both. The individual circumstances may get you to incline to doing it one way or another, but it is possible to do both. It is easier definitely to manage a few large accounts. So if you have super agents and they're lent the money and then they have to manage the agents separately, it is one way of doing it. But it is also possible to actually lend the agents. Remember, we talked about, assessing and presenting the qualified agents. So if you end up with a very large number of retail agents who don't qualify, they don't meet the criteria, even if you want to support them, there is a certain criterion that must be met. If they don't meet the criteria, then you may result to lending at a higher level and you let, say, the super agent deal with the smaller agents if they don't qualify. But if you have a good number of retail agents who can actually meet the cut, then I think it is possible. It is actually possible to lend them directly if you are the institution that is lending. Again, that is about their own status at the point at which you want to lend them. The third question was about interoperability. Yeah, so why would a telco want to share their network, their agent network, after investing so much in building it? I think that was the question. And I think this is a question of the level of maturity in the market. If the level of maturity is such that they can see they're approaching saturation, and this was actually the case in Tanzania. All these players were working very hard. They had all built a network. They were all competing for customers and everything. And it therefore became apparent to them that the growth is going to plateau. And if they don't expand beyond what they were already doing, then probably they'd all be working against themselves. And therefore they appreciated that if, in fact, the first request came from a telco that already had a network. They said they're willing to share theirs. Would the others also open up their network so that they have an interoperable system? So if agents would also see that by serving other customers from a different operator, they'll be able to make more money, then they'll be able to see the sense. Now, if they make more money, it is better for everybody, because if they make more money, then they are more strong, they're more resilient, they'll be able to support customers better. And at some point, it may not matter how many other customers are being served, but as long as yours as the telco, as long as your customers are being served and more of them are being served, it would work for you. But again, remember, depending on the commercial agreements, there could also be a possibility to earn revenue when your network serves customers of another network. And therefore, you may want to just look at it more broadly and look at all the benefits. The benefits are there. And if you get that perception, then you realize that you may have invested, but it's still okay to share the network, because you will also gain access to other networks that you never invested in. We've seen that it's a bigger problem where you have maybe one dominant player who probably has 70% of the market and the rest are nothing. Of course, the dominant player would be very hesitant to share their network because they see, for them, there's everything to lose when the others are seeing everything to gain. But when it is more balanced, then you're likely to have better agreements being crafted between the parties that are going to do this. Okay. Now, the third one, the last question, if I remember, was about whether operators build the agent networks from scratch or they ride on an existing network. I would say we've seen both. we've seen both. One of the most successful telcos that we know in this field, Safaricom in Kenya, built their network from scratch. They did not ride on anyone that existed because this was a new business. They built it from scratch, a lot of hard work, a lot of investment, but it paid off in the end. We have also seen other operators in other markets riding on existing distribution networks, maybe people in FMCG. It works both ways. I think it all depends on the circumstances, the environment in which you're operating. There will be costs involved in building an entire new network, but there are also advantages of building it because then you get them focused on your business, you train them, and that will probably be the first formal business that they're doing with the rules and regulations, and therefore they would tend to be more disciplined. But it comes with a cost. On the other hand, if you were to ride on an existing partnership, then you have to take care of the possible conflicts and where your business is going to be placed in terms of priorities. If, for example, you decide to ride on a network that supplies beer or a network that supplies soft drinks, where will their focus be? If capital is strained and they don't have enough money, will they put the money in the soft drinks or will they put the money in the liquidity that you need for the business? I think those are the considerations that one would make, but it can work both ways. It just has to be a very well considered balance between the cost and benefit.
Great, thank you, Jerry. There's one last question that we have about who regulates and provides oversight over the agents or the entire network. Is it going to be something coming directly from the central bank or the financial institutions, specifically in mobile payments in that context?
In mobile payments, the regulator, typically the central bank, and to some extent, in some markets, you find the communications authority also getting involved. But typically, because it's financial services, the regulator would be the central bank. So the rules or the regulations would be set by the central bank. But then the enforcement of these rules and the actual implementation of the provisions of these regulations typically would be enforced by the operator. The bank in this case, or a telco in this case, would then have to have mechanisms of ensuring that those rules are not violated, and therefore there is a responsibility for the operator to make sure that their network, in fact, most regulations will put that responsibility squarely on the operator to make sure that there is total compliance, because when there is lack of compliance amongst your agents, then the regulator would typically come for you because you're the one who's regulated.
Okay, brilliant. There is a gentleman that has a question. I don't know, Mahmoud, if you want me to read it out or you want to verbalize it. But question is basically, does the current environment in Sudan restrict agent exclusively, or is it open and not defined? I don't know if Jerry can answer that question. If we have some participants from the regulator side.
Maybe someone who's more familiar with the regulations in Sudan currently.
Yeah, so I don't know if anyone in the audience is able to take that question on. So does the current environment in Sudan restrict agent exclusivity, or is it open and not defined? Does anyone have an answer for that? To the best of your knowledge.
I may take this question, Mohammed. There is no clear regulations regarding agent network management, although authorities encourage agent interoperability in terms of mobile money, but there is no clear regulations and directives up to my knowledge. This in regard of mobile money agent, but if you refer to telecom agent, there is no exclusivity at all. The same agent works for the 3 operators.
Okay, brilliant.
Okay. I
Thank
think
you
what,
for that.
if I may just answer from the rest of the regulations that I'm familiar with, more and more we are finding regulators actually talking against exclusivity. They want to have an open network, and therefore some markets that started with exclusivity have recently been stopped from having an exclusive agent. So I think more and more we are finding regulators being against exclusivity. They want to have an agent who can serve other operators as well, because I think it works then for financial inclusion. It works best for the resilience of that network. Thank you.
Okay. I'd like to remind everyone that there's a survey. Please make sure that you take the time to fill it. I see there is one last question that came up, but it's pretty much directed. And I don't want to put Amrabi on the spot to have to answer that question. So if he has to decide if he wants to or not. I know that he has lots of experience and depth in that domain, but may not be in a position to answer that question at this moment. So with that, I'd like to, say thank you and really appreciate the efforts and the contributions of everyone that participated in this series. Special thanks to IFC and the guidance of Margaret and her patience and waking up with us, despite the differences in hours. Really thankful for the contributions and the knowledge that you guys have been able to share. Please, everyone, take time to give us some feedback on the evaluation form, so that way everyone can work their hardest to making things better in the future. There was a question earlier whether the slides are going to be available. So along with the content of the webinar and the recordings, I'm pretty sure the slides will also be afforded, and maybe they will be sent out in a link for downloads, or maybe just shared as an attachment. And finally, please take time from your busy schedule to participate in the Shumul activities. The goal of the organization is to basically bring literacy and financial inclusion and awareness and policy advocacy, basically the same building blocks that IFC has been able to lay out for us over these series. And we want to work with everyone, and we welcome your contributions and participation, because without everyone chiming in, I don't think we'll be able to make a big difference. But with you, definitely there will be a big difference. So once again, thank you for the time, and thank you for for the IFC. Thank you, Jerry. Thank you, Margaret. Manal, for being the hero behind the scenes. I just get to talk when it's convenient. But I want to thank everyone, and thank you for your time again. Enjoy the rest of your day, and talk soon.
Thank you.
Thank you very much, Mohammed, and thank you, Jeremy, and all the other participants for joining us today.
Cheers.